Welcome to Hot Sectors, a monthly program by Mirae Asset Securities Vietnam. My name is Inse and I'll be your host today. Recently, Vietnam's petroleum sector has been gaining momentum, driven by expectations of favorable new regulations, a topic I'm sure many of you are already following with interest. These upcoming guidelines are anticipated to bring comprehensive reforms to the business environment for companies operating in the sector, opening a new chapter for these enterprises. So, in today's episode, we will take a closer look at the current market landscape and explore what lies ahead. With insights from industry expert from research department here, Mr. Dewey Nguyen, an analyst specializing in the gasoline industry. Hi, Dewey.
Hi, Anse. Nice to meet you.
Nice to meet you. Thank you, gentlemen, for joining us. To start off, before we dive into the outlook, could you share a quick update on the current state of the market for our audience?
Yes, of course. Actually, over the past 10 years, I've seen a strong increase in consumption volume, one that has even outpaced the GDP growth, which itself averaged around 7% during this period. The exceptional growth has been driven by several factors. But I say the key contributor are the rising number of the vehicles on the road, or the rapid expansion of logistic network, and increased industrial activity across the country. Looking ahead, the demand is expected to remain stable, growing at around 8% per year. However, to be honest, the petroleum sector is pretty unique because it remains specially regulated by the state. Currently, it's managed by three key regulatory frameworks: Decree 83, 95, and 80. But right now, this framework has started to show their limitation. They haven't really kept up with the rapid and the unpredictable change in the global oil market. And so the financial results of the fuel company don't really reflect how volatile the market has been.
Okay, behind the number of past stabilization growth, the gasoline chain has been confused significantly over the past 3 years. I've seen many gas stations shut down, and in some cases, even traders had their license revoked. This is your take on the issue, Dewey. What were the underlying causes, and how do you see it affecting the sector going forward?
The market was heavily impacted by the COVID pandemic, which pushed everything to extreme, from the oil price to the shipping cost. However, under the outdated framework of the Decree 83 combined the unfavorable domestic condition, many companies revealed the weakness in their cash flow management, especially in how they handle the price stabilization fund. This mismanagement triggered comprehensive state inspection. As a result, over the past 3 years, the number of petroleum traders has dropped by around 20 to 25%. Additionally, looking back the pre-pandemic market structure, those traders who were penalized previously held around 15% of the market's share. So with the exit, this share is now being quickly absorbed mainly by Petrolix and oil. Actually, this implies the vacated market share translates into an intensive market share race, driven by two financially strong players. As on our screen, we can see both companies has responded well to this trend, and they demonstrated clear improvement in sales efficiency and market share expansion. However, after looking deeper into the data, I see PV Oil has been gaining market share at a solid pace, clearly outperforming its peers. BOS has not moved as quickly during the same period. Looking ahead, despite the unfolding trend, I believe it's nearing an inflection point because the signal of the stability are appearing in the retail scene.
Can you walk us through the main differences between Petrolix and PV Oil? And more importantly, how are those differences reflected in their financial statements? I think this will help investors better understand the strategic positioning and performance of each company.
We we can clearly see that Petrolix is now focusing on more expanding its margin by busting the CO channel rather than just trying to grow sale volume. You know, the CO channel actually generated nearly a double gross profit compared to the DODO channel. In contrast, PVOI has responded by prioritizing volume over margin, accepting lower gross profit to expand its market position. So its gross margin has come under pressure due to its aggressive pricing strategy, offering higher discount to gain market share. For POS, this is almost impossible under competition law 2018. Any firm holding more than half of market share would come under tight regulatory scrutiny. That's why POS has kept its market share below that the threshold set in 2019. At the same time, oil ain't affected by the constraint. As a result, we can see its market share grew from 14% to in 2020 to 22% until now. So in a strong momentum and room for further expansion. Actually, the strong focus on expanding market share has come at the expense of profitability. So we can see that oil profit per unit stop gasoline is just around 1/3 of POS. On top of that, the structure of its distribution channel makes oil more sensitive to oil price volatility, leaving it more exposed to shorter market swing compared to POS. We've actually covered this topic in detail in earlier Mark Select, especially when highlighting how distribution model affect exposure to price volatility.
Thank you for the clear answer. Beyond the ongoing trends and the contrasting strategies between the two leaders, I believe the comprehensive regulatory overhaul is what investors are currently most interested in. How do you think these regulatory changes might impact on the companies operating in the sector?
You know, the key point behind the change is to reduce the state control over the sector. It could pave the way for greater market liberalization and increase the competition. So what I'm finding the most notable is that the authorized seem to be fully committed to allowing the market player to operate under a real market mechanism. As you can see on the screen, on price components are enabled to self-determine without direct state intervention. This trend we have seen in the previous version. Meanwhile, based on the current framework, the player are only allowed to set their selling price below a base price, even though on component are regulated sticky. The outdex management has long limited pricing flexibility that I have mentioned. So I expect the new pricing mechanism will make a new cycle for the petroleum segment. The initiative will provide significant competitive advantage to market leader POS and oil, who together dominate 2/3 of the market. I believe the application of the new regulation will also lay the groundwork for profit margin expansion because it allows the business to better represent actual costs or operate with the greater pricing flexibility.
Given our previous discussion, could you elaborate on the stock components, particularly the performance and outlook of key listed players in the gasoline sector like Petrolix and PV Oil?
So because the sharp decline in the Brent in the first 5 months, both companies report disappointing results. You know, the high cost of inventory eliminated nearly 90% of their earnings. And even though the Brent has recently increased a lot due to Iran and Israel conflicts, domestic fuel price haven't been adjusted yet. That's why I believe both companies are likely to release the same quick result this quarter, much like what we saw in the past before seeing a recovery in the second half. As I've highlighted multiple times on Marcellus regarding oil and POS, it's clear that two companies have taken wide different approaches recently. Oil in particularly tend to more sensitive to brand movement compared to POS. So if the brand continue to rally, I expect oil could deliver a strong performance and potential generate more impressive profit than its peer.
Also, is this the right time to consider adding these stocks to the portfolio?
That's a good question. So I just mentioned we are now looking at a compelling story. I think what's been driving the price action in the short term is more sentiment than fundamental, with speculative cash flow taking the lead. Actually, both stock price react positively to the event, with the gains of around 15%. Based on my scenario analysis of how the brand price trends impacting their valuation, until now I see only PLS remaining an attractive valuation. Meanwhile, for oil, it looks like to be fair with most of the positive outlook already priced in. As I mentioned earlier, oil tends to be highly sensitive to the brand price movement. Actually, oil stock price increase in a short period of time. It demonstrates high market emotion, especially as a brand is gaining momentum towards the $80 mark. And currently, the market is even starting to bet that price could break over $100 if the conflict continue to escalate. So I want to emphasize that the current price movement is driven by the short-term sentiment rather than the fundamental. Therefore, the investor should make a well-considered decision that's aligned with their risk appetite or return expectation.
So that's it for our final question in this episode. We hope the insights shared today will help investors make more informed decisions moving forward. All right, thank you so much for joining us, Dewey. I really appreciate you taking the time to be on the show. Goodbye, and we'll see you again in the upcoming episodes from Mirae Asset Securities Vietnam. Don't forget to subscribe to our channel and turn on notifications so you don't miss any of our latest updates.